You survived the grueling audits of the Canada Revenue Agency. You navigated the devastating realities of the exit tax and the death tax. You watched our recent investigation into the eviction mill, and you realized exactly how fast the major financial institutions can deploy their automated legal factories to seize your family home if you miss a single mortgage payment. You put your defensive strategies in place. You budgeted, you sacrificed, and you mentally prepared yourself for the worst case scenario. You sat down with your family and had the difficult conversation. You told them that even if the absolute worst happens, even if the bank ultimately forecloses on the house and the sheriff changes the locks, you will still survive. You told yourself that you still have your job, you still have your steady paycheck, and you still have the cash sitting in your checking account to rent a new apartment, buy groceries, and keep your children fed while you rebuild your life. You believed that the boundary between your debt and your daily survival cash was an impenetrable wall. You believed that no matter how aggressive the bank gets with your mortgage, the money you actively earn and deposit into your daily checking account is strictly yours. That belief is the most dangerous, widely accepted financial illusion in Canada today. That impenetrable wall does not exist. It never existed. That the bank simply allowed you to believe it was there while the economy was stable and interest rates were at rock bottom. But the economy is no longer stable, and the era of banking compassion has been officially terminated. Welcome back to Canada Property Watch. Today, we are exposing the ultimate, deeply hidden financial trap operating inside the Canadian banking system. We are going to reveal a legal mechanism so ruthless, so entirely automated, and so heavily concealed within the fine print of your banking agreements that 99% of Canadians do not even know it exists until they are standing at a grocery store checkout line, staring in absolute horror at a declined debit card. Today, we are pulling back the curtain on the right of offset, the mechanism that allows your friendly neighborhood bank to legally, instantly, and without zero warning, completely drain your checking and savings accounts to zero to cover your bad debts. To understand the terrifying absolute power of the right of offset, we have to completely deconstruct the way you think about your relationship with your bank. For decades, the major Canadian banks have spent billions of dollars on brilliant marketing campaigns designed to make you view them as a safe, compartmentalized vault for your life. They encourage you to bring all of your financial products under their single roof. They offer you convenient bundles. They give you a checking account for your daily expenses, a high-interest savings account for your emergency fund, a credit card for your online purchases, a line of credit for your home renovations, and of course, the massive mortgage for your primary residence. When you open your banking app on your smartphone, you see these accounts neatly separated into different rows. You see a clear visual boundary between the money you owe the bank, like your mortgage balance, and the money the bank holds for you, like your payroll deposit. This visual separation is a deliberate psychological trick. It gives you a profound false sense of control. From a strict legal and contractual perspective, those separate rows on your smartphone screen do not exist. When you sign the master terms and conditions to open a bank account in Canada, you are signing a deeply complex, universally binding legal contract that establishes a global relationship with that specific financial institution. Embedded deep within those 50 pages of dense, microscopic legal jargon that nobody ever reads is a specific clause called the right of offset, sometimes referred to as the right of set-off. This single paragraph completely overrides the visual separation on your banking app. It fundamentally states that if you owe the bank money on any credit product, whether it is a missed mortgage payment, a maxed out and delinquent credit card, an overdrawn line of credit, or a defaulting auto loan, the bank possesses the absolute unilateral legal right to reach into any other account you hold with them that has a positive cash balance and instantly seize those funds to satisfy the debt. They do not need to ask for your permission. They do not need to send you a warning letter in the mail. They do not need to take you to court. And they certainly do not need a judge to sign a garnishment order. You already gave them explicit, legally binding permission to take your money the very day you opened your checking account. Let us walk through the exact, terrifying timeline of how the offset trap is actively triggered in the current economic environment. We are currently witnessing an unprecedented wave of financial distress across the Canadian middle class. As we exposed in our investigations into the T4 trap and payment shock, Hundreds of thousands of families are currently hitting the wall. Imagine a family that has held their mortgage with a major Bay Street bank for 10 years. They also have their primary joint checking account at this exact same bank, where both spouses have their bi-weekly salaries deposited via direct deposit. And due to the catastrophic rise in the cost of living, massive property tax hikes, and a brutal mortgage renewal at a significantly higher interest rate, the family's monthly budget finally breaks. They exhaust their emergency savings. They max out their credit cards just to buy basic groceries and put gas in the car. Finally, the inevitable happens. The first of the month arrives. The massive pre-authorized mortgage payment attempts to clear the checking account, and it bounces due to non-sufficient funds. In the past, a bounce payment would trigger a polite phone call from a local branch manager a few days later, asking if there was a simple oversight or if the family needed to temporarily defer a payment. As we learned in our eviction mill investigation, that human element has been completely eradicated. Today, the bounced payment triggers a silent algorithmic alarm within the bank's automated risk management mainframe. The family realizes they missed the payment and they are terrified, but they make a desperate strategic decision. They decide that they need to prioritize raw survival over the mortgage debt. They know the bank cannot legally kick them out of their house tomorrow. The power of sale process takes months. So, they decide to keep the upcoming Friday paycheck in their checking account to ensure they can buy food for their children, pay the hydro bill so the lights stay on, and keep their auto insurance active so they can still drive to work. They believe they have bought themselves a tiny, crucial window of breathing room to figure out their next move. Friday morning arrives. The employer's payroll system successfully transmits the salary directly into the family's checking account at 3 in the morning. For a brief, fleeting moment, the checking account shows a positive balance of $3,000. But the bank's internal algorithm is already watching, but waiting for precisely this moment. The instant that direct deposit registers as cleared funds, the right of offset protocol is automatically, mercilessly executed by the computer system. Before the family even wakes up, before the sun even rises, the algorithm initiates an internal transfer. It takes the entire $3,000 out of the checking account and applies it directly to the arrears on the delinquent mortgage account, plus the non-sufficient funds penalty fees. When the family wakes up at 7 in the morning, the husband stops at the gas station on his way to work. He fills up his tank, walks inside to the counter, and taps his debit card. The machine beeps loudly and displays the word declined. He assumes it is a simple chip error. He inserts the card and types his PIN. Declined again. Confused and slightly embarrassed, he steps aside and opens the banking app on his phone. The screen loads. And the checking account balance is exactly $0.00. Below the balance, in the transaction history, is a cryptic line item that simply reads internal transfer offset or funds reallocation to credit facility. The psychological devastation of this exact moment is impossible to overstate. It is the sudden, violent realization that you have lost complete control over your own survival. The husband immediately calls the bank's customer service hotline, and his heart pounding in his chest. He waits on hold for 45 minutes, eventually reaching a call center representative. He frantically explains that a mistake has been made, that his entire paycheck has disappeared, and that he needs that money immediately to feed his family and pay his utility bills. The representative looks at the file, reads the automated notes left by the system, and responds with a cold, scripted, legally approved corporate response. They politely inform him that because his mortgage account was in arrears, the bank exercised its contractual right of set-off to recover the funds. They will tell him that the action is final, irreversible, and completely legal. They will not refund the money. They will not leave him a few $100s for groceries. The bank has secured its asset, and the family's immediate survival is fundamentally not the bank's problem. The immediate theft of the paycheck is just the opening salvo of the offset trap. What follows is a cascading, catastrophic chain reaction of secondary financial failures that will absolutely obliterate the family's remaining stability within a matter of days. Because the bank wiped the checking account to zero without any warning, all of the family's other automated bills and pre-authorized debits are now programmed to crash into a brick wall. The next day, The hydro company attempts to pull the monthly electricity payment from the empty account. It bounces. The auto insurance company attempts to pull the monthly premium. It bounces. The daycare center attempts to pull the childcare fees. It bounces. For every single one of these bounce transactions, the bank, the exact same bank that just emptied the account, will gladly charge a non-sufficient funds fee, typically around $45 to $50 per bounced item. The account is suddenly driven into a deep negative overdraft balance composed entirely of punitive bank fees. But the damage goes far beyond the bank's internal ledger. Because the auto insurance payment bounced, the insurance company may immediately cancel the family's policy for non-payment, making it illegal for them to drive to work. Because the hydro payment bounced, the utility company issues a disconnection notice. Because the daycare payment bounced, and the children lose their spot at the facility, forcing a parent to stay home and potentially lose their job. The bank's use of the offset clause does not just collect a debt, it detonates a financial bomb in the center of the family's life, accelerating their total collapse and ensuring they will never have the resources to hire a lawyer or fight the impending foreclosure. We must ask ourselves how such a predatory, instantly destructive mechanism is allowed to exist in a supposedly regulated, uncivilized financial system. The reality is that the regulatory bodies, including OSFI and the Financial Consumer Agency of Canada, not only allow the right of offset, they view it as a perfectly legitimate, necessary tool for maintaining the stability of the national banking sector. The government and the regulators prioritize the health of the financial institutions over the immediate survival of the individual consumer. The legal justification is rooted in common law principles that date back centuries. The argument is that if two parties owe each other money, it is only logical and efficient that the debts be canceled out against each other. When you deposit your salary into a checking account, you are technically lending that money to the bank. The bank becomes your debtor. If you simultaneously owe the bank money for a mortgage, the bank is your creditor. The right of offset simply allows the bank to collapse those two debts into a single net position. But this legal theory completely ignores the brutal, real-world power dynamic between a multi-billion-dollar Bay Street institution and a working-class family struggling to survive a manufactured cost-of-living crisis. It treats the money required to buy baby formula and insulin with the exact same level of legal detachment as a corporate bond transaction. And the banks fiercely defend this practice because it is the ultimate fail-safe collection mechanism. Why would a bank spend thousands of dollars paying the eviction mill lawyers to sue you, secure a judgment, and apply for a wage garnishment through the court system, a process that takes months and offers you the chance to defend yourself before a judge, when they can simply write a clause into the fine print that allows a computer algorithm to legally bypass the entire judicial system and instantly confiscate your cash the second it hits their ledger. The offset trap is the ultimate privatization of the legal collection process. It strips you of your right to due process, then your right to prioritize your family's basic needs, and your right to defend your assets. The true horror of the offset trap is that its reach extends far beyond just missing a massive mortgage payment. The banks use this exact same weapon to brutally enforce their unsecured credit products. Let us look at a different, incredibly common scenario that is currently destroying young professionals and fixed-income seniors across the country. Suppose you have no mortgage, but you have a checking account and a standard credit card with the same major bank. Over the past year, as inflation decimated your purchasing power, you relied on that credit card to cover the widening gap between your income and your basic expenses. You maxed out the $10,000 limit. For months, you meticulously made the minimum monthly payments, barely keeping the account in good standing, while the 22% compounding interest quietly devoured your future. Then, you face a sudden, unexpected crisis. Your car transmission blows up, or you require emergency dental surgery that is not covered by the government. You miss 2 consecutive minimum payments on the credit card. The bank's collection department begins calling you incessantly. You ignore the calls because you simply do not have the money to give them, and you are waiting for your next payroll deposit to clear so you can finally catch up. You assume that because a credit card is an unsecured debt, meaning it is not backed by collateral like a house or a car, the bank's only recourse is to ruin your credit score or eventually sell the debt to a third-party collection agency. You mistakenly believe your cash is safe. The moment your payroll deposit hits your checking account, the exact same algorithmic trap snaps shut. The bank exercises its right of offset. They do not just take the amount of the missed minimum payments. If your credit card account has been flagged as seriously delinquent or in default, the bank has the legal right to accelerate the debt, calling the entire $10,000 balance due immediately. If you have $3,000 in your checking account from your salary, the bank will seize every single penny of it, apply it to the $10,000 credit card balance, and leave you with zero cash and a remaining $7,000 debt. They will instantly trade your ability to pay rent and buy groceries for a slight reduction in their unsecured liability. They will paralyze your life over a plastic card. The danger compounds exponentially for the hundreds of thousands of Canadians who operate small businesses, independent contracting operations, or freelance gigs. When Canadian banks aggressively push entrepreneurs to open their small business operating accounts at the exact same institution where they hold their personal mortgages and personal checking accounts. They sell this as a convenient, streamlined way to manage your entire financial universe with a single login. This convenience is a perfectly engineered, devastating trap known as cross-collateralization. Imagine you run a small plumbing company or an independent consulting firm. You have a business operating account where your clients pay your invoices. You also took out a $40,000 unsecured business loan from the bank during the pandemic to keep your operations afloat. In your personal life, completely separate from your business, you hold your family mortgage and your personal checking account at the exact same bank. The economy tightens, consumer spending plummets, and your small business hits a severe dry spell. Clients are paying late, which contracts are drying up, and you inevitably miss a payment on that $40,000 business loan. You might logically assume that the bank will pursue the business for the debt, perhaps sending the business loan to collections. You assume your family's personal finances are shielded by the corporate structure of your business. But when you sign the paperwork for that business loan, the bank almost certainly required you to sign a personal guarantee, linking your personal liability to the corporate debt. And because all of your accounts reside within the same institution's walled garden, the bank's algorithm sees no difference between the business entity and the personal entity. When the business loan defaults, the bank's system initiates a massive cross-account offset sweep. It will first empty whatever remaining funds are in your business operating account. If that is not enough to satisfy the $40,000 debt, the algorithm will ruthlessly cross the boundary into your personal financial life. It will instantly drain your personal checking account. It will reach into your high-interest savings account and empty the funds you were saving for your child's university tuition. If you have a tax-free savings account or certain types of non-registered investment accounts sitting in cash within the same banking umbrella, the bank will attempt to liquidate those as well. The bank will systematically dismantle your family's entire financial safety net to satisfy a defaulting commercial loan, effectively destroying your personal life to balance their corporate ledger. The wall between your business and your family is an illusion maintained entirely at the bank's convenience. This brings us to the most critical, actionable intelligence of this entire investigation. How do you defend yourself against a weapon that is completely legal, entirely automated, and requires absolutely zero warning to deploy? The answer is brutally simple, yet the vast majority of Canadians fail to implement it because it requires breaking a lifelong habit of convenience. You must immediately, systematically dismantle the global relationship you have built with your primary bank. You must build an impenetrable firewall between the institutions that you owe money to and the institutions that hold your liquid cash. This strategy is known as banking diversification, and in the current economic collapse, it is no longer just a good idea. It is an absolute survival requirement. The right of offset only works if the bank has access to both the debt and the cash. A bank in Canada cannot legally reach across institutional lines and seize funds from a completely different, competing bank without going through the arduous, time-consuming process of obtaining a formal court judgment and a garnishment order from a judge. If your mortgage, your line of credit, and your major credit cards are held with Bank A, you must immediately open your primary checking account and your emergency savings account at Bank B. Furthermore, Bank B should ideally not be another one of the big 6 major banks, because they often share similar aggressive risk management protocols and are highly interconnected. Your safe haven accounts should be opened at a provincial credit union, a localized financial cooperative, or a dedicated online-only alternative bank. And once you open the new checking account at the independent institution, you must immediately contact your employer's Human Resources Department and redirect your payroll direct deposit to the new safe account. You must manually move your hydro bills, your internet bills, and your car insurance pre-authorized payments to draw from this new account. It takes effort. It requires updating passwords, filling out new direct deposit forms, and managing multiple apps on your phone. And it destroys the convenience of the bundled banking model. But that inconvenience is the exact price you must pay to ensure your family's survival cash is insulated from the automated algorithms of Bay Street. If you suspect that you are heading towards a default on any credit product, whether you foresee missing a mortgage payment next month or you know you cannot make the minimum payment on a maxed out credit card, you cannot wait until the day before the payment is due to move your money. Remember, the banking algorithms are lightning fast, and if the funds are still sitting in the connected checking account when the default registers, the money will be gone before you can log in to transfer it. You must establish this firewall while your accounts are still in good standing, long before the bank's risk management software flags your profile as a liability. The Canadian banking system is currently executing a massive silent purge, and they are terrified of the hundreds of billions of dollars of toxic, underwater debt sitting on their balance sheets. They know that a massive wave of defaults is not just possible. It is mathematically inevitable as millions of homeowners face catastrophic renewal rates over the next 24 months. The banks are not waiting for the government to save them, and they are certainly not waiting to help you. They are proactively arming their automated systems to extract every single available dollar of liquid cash from their most vulnerable customers to pad their reserves before the crash fully materializes. They are using the eviction mill to seize your equity, they are using the T4 trap to recall your loans, and they are using the offset clause to legally drain your checking accounts to zero while you sleep. The mainstream financial media will never warn you about this. They rely on the massive advertising revenues generated by the very banks that are executing these policies. The bank's marketing departments will continue to send you smiling emails about customer loyalty and financial wellness, while their algorithms quietly scan your checking account, waiting for the perfect moment to strike. You must stop treating your bank as a trusted partner and start treating it as a highly sophisticated, predatory counterparty. You must read the fine print. But you must build your financial firewall today. Do not wait until you are standing at the grocery store, staring at a declined card, trying to figure out how you are going to feed your family because the bank legally confiscated your entire paycheck. Subscribe to Canada Property Watch. We are reading the contracts, we are exposing the algorithms, and we are delivering the unfiltered, unvarnished intelligence you need to survive this systemic financial collapse. The rules of the game have been violently rewritten to protect the billions of Bay Street, and your ignorance of these mechanisms is their greatest weapon. Secure your cash, diversify your institutions, and prepare for the storm. We will see you in the next investigation.